Hey guys, Logan Hicks here. Today we're going to talk about a favorite topic of mine, and that is credit. Credit is an awesome tool that can be leveraged to make you a lot of money, buy a lot of incomes, acquire a lot of incomes, acquire a lot of capabilities that you normally wouldn't have or have access to. Now, there's quite a few things about credit that I'm actively involved with. I'm actually writing several books on credit right now and related to financing. As some of you may know, I've actually created my own finance company that I'm moving very quickly into becoming an international finance company and then an international bank. And so I'm very passionate about finance. I feel finance is a very powerful tool that can be leveraged to garner a lot of success for a lot of people who otherwise wouldn't have access to it. So we're going to jump right on it in here. It's one of my favorite topics. So let's jump in here and get started, man. All right, so when you're looking at credit, the issue with credit is most people don't actually understand credit to an intimate level. Now, I'm sure you've seen a lot of those videos out there like, oh, well, this is your credit score, these are the things, here's how it's rated. We're going to really break down into credit, and I'm going to actually show you how credit really works. So it's really cool. There's a lot of interesting things about credit. A lot of the stuff that you hear out there is not accurate. A lot of things that you hear from the quote-unquote gurus is totally wrong. They go about things the completely opposite direction. It's normally a really bad idea. There are very few actually good credit companies that are out there. Either credit repair services or credit augmentation services, as I like to call them, because that's what they really are. They're augmenting your credit score to help improve it. But we're going to cover all of those. So let's jump right in there. What is your score actually comprised of? So your score is broken down into 5 primary categories on public facing, but several more categories on the back end. Now, on your credit score, you've got your payment history, which is 35%, your outstanding debts, which is 30%, your line of credits, which is 15%, your mix of credits, which is 10%, and your pursuit of new credit, which is another 10%. So that collectively makes up your entire credit score. But what does that really mean? See, this is where the first mistakes are made. So what is your payment history? Your payment history is gauged on the 90 to 100% bracket percentile. This is how your score is really assessed. Anything below that, you're getting 0 points. So there's not like, oh, well, I missed half of my payments, but I still get half my points, right? No. It's you missed more than X number of payments, you get no points. No buenos. So it's not possible to get a 0, just so you're aware. It's not mathematically possible to get a 0. It's impossible. The system's been made to do that. You have a minimum credit score, and that's what that score is. Now, with that being said, your payment history. So say, for instance, you have 3 credit cards, a car payment, and a house payment. You've had the house for a year, so there's 12 payments. You've had the loan for a year, and that's 12 payments. And you've had the credit cards for 3 years, so that's 36 payments by 3. So that's 36 by 3. What is that? Math, 18, 108, 108. All right, so you got 108 payments. All right. Well, let's say you've missed 2 payments on your credit cards apiece because you had some issues back when you were like 19. So there's 3 on there from like 2 years ago. So it's 2 years ago. They're 2 years old. And you missed 2 on each, so that's times 3. That's 6 payments that you've missed. So that's 6 payments that you've missed. And then 12 and 12. You never missed anything on your personal loan. You never missed anything on your house. You're doing great. That's awesome. That's absolutely awesome. Here's the problem. You have 102 of 108 payments, plus you've got 12 and 12 is 24. So you've got 126 of 132 payments paid on time. That's what your actual score looks like there. That is how that 35 points is actually done. And that is a grand total of, what is that? I'll use a calculator real quick. That's 95.45 repeating. So you've got a 95% paid on time ratio, roughly. 102 of 108. Because of 6 credit card missed payments, you are going to take a hit of 100 to 150 points. So if you had a 700, it's a 600. If you had an 800, it's a 700. Realistically, the higher scores take a bigger hit, so you're probably at a 650. Isn't that crazy? Person with a worse score is going to take less hits than you with a better score. That is insane. This is one of the first reasons why I don't like the credit system as it currently stands. Because a person with an 850 credit score misses a single payment, one, I'm probably not going to believe that it was missed in the first place, because the odds of a person with a perfect credit history is almost zero. Then on top of that, for a person to miss that payment, that is also almost completely unheard of. So the likelihood of me believing that in the first place as a lender is almost next to zero. Now, the other issue with that is that 800 credit score is going to take a 100+ point hit for one mistake. One mistake is going to hit you way harder than the average person. And the reason is quite simple, because your score is higher. The system is mathematically designed to penalize those with perfect scores that ever make a mistake, and the system is not designed to heavily penalize those who have made mistakes in the past. So this system is designed to put you in a bracket to where you're still lendable to at a much higher interest rate. So go ahead and keep that in mind. This system is rigged. It is in fact rigged, mathematically verifiably rigged, in the favor of lenders to charge you more money. So let's just go ahead and put that out in the open air and move on. So how does it actually work? Actually, you know what? Let's go back and look at some of these other ones. I want you to understand the outstanding debt too, because a lot of people seem to mistake. You know what? We're going to cover all those. I was going to just make this a 10-minute video, but we're going to make this a lengthy video because I really want you guys to understand these topics. So outstanding debt, let's take a look at outstanding debt. So when you have, let's say, a $10,000 credit line on those credit cards we just talked about. So you got three of them, $10,000 a piece, $30,000. So you got $10,000, $10,000, $10,000. That's $30,000. Here's the issue. A lot of people seem to think, oh, if it's 30% utilization, then I'll hurt my credit score. That's not the case. If you exceed over 5% of any of these card utilization, your score is going down. Your score is taking a hit. What this 30% utilization represents is a substantial hit to your credit score. You're already taking a hit the second you exceed 5%. The system, again, is designed to penalize you for leveraging credit. Why? Quite simple. Because if you use credit, they want to charge you money. They can't charge you money if you have perfect credit, because anyone will give you a card. It's a highly competitive environment, so they want to penalize you for leveraging credit. So if you use credit, they say you're a quote-unquote risk, even if you have billions of dollars, which I openly laugh about, because the one thing they don't consider is your ability to pay it back. Your credit score does not currently leverage the capacity of you to be able to pay the money back. Of all the things for a credit score to not have in it, they claim, by the way, which is the ability for you to financially pay back your loans, does not impact your ability to pay back those loans. If that makes any sense, because it never has to me. If you can't afford the loan, you can't pay it back. That's pretty basic logic. Not according to the credit score bureaus. So whatever. But, so you've got a $30,000 in credit here. The truth, if you use more than 5%, you're taking a hit. At 30%, you take a substantial hit. At 50%, and again at 70%, you take another hit. You take a hit, you take a hit, you take a hit. Your scores aren't going to increase or decrease until you pass those thresholds. That does not mean that that threshold is per card. That threshold is per line set. So if you have $30,000 in usage capacity, what that means is it's $30,000, 10% of that, 20% of that, 30%, not 10%, 20%, 30% of $10,000, which is each credit line, but of your entire available line base. That is where that is calculated from. So what I always recommend to people, have multiple credit cards. Actively only ever use one credit card. Ever. Ever. Use one to keep it open with something like gas, another one to keep it open for something like Netflix, use another one to keep it open for something like Pandora. Something that's very, very, very low cost. I recommend less than $10 a month. And then constantly pay off those cards. Make sure those cards don't have annual fees, because those will eat you and you'll miss them and you'll get hit on your credit because you missed it. Now, the reason why this is a benefit, if you have really good credit cards, like the Capital One cards, like some Discover cards. These cards have great cash back benefits, and that cash back does add up. I've seen friends of mine who have $7, $8, $900,000 in cash back from just business transactions they're constantly swiping for and just paying off immediately. And it doesn't hurt them because they're constantly paying it off, paying it off, paying it off, paying it off before any interest accrues. And so they're just racking these points up like crazy, like crazy. And they'll go in and they'll buy first class tickets for their entire friend set. They'll go in, they'll buy an entire night at the bar. They'll pay for hotels. They'll buy trips for their family. They'll buy cars. I saw one guy buy a car with points. It was crazy. But these points add up, and you can save them, especially if they don't ever expire. It's awesome. It's absolutely awesome. Good cards make for great friends. Now, length of credit. This is also something that I drastically vary against with my current industry peers. And that's because I find that the discrimination based on lines of credit age is a distinct limit correlating directly to life limit. If you've only been alive for 25 years, you can't have a 25-year line credit limit, which means they're discriminating based on your age. That's what I feel that it is. They're categorically group-based discrimination, and I don't agree with that because an older person does not necessarily mean that they're more credit worthy. That just means they're older. I've seen people that are in their 60s and 70s go completely bankrupt. I've seen people in their 20s go completely bankrupt. There is no distinctive difference between age. It's just performance financially. And Social Security users are about to find that out the hard way and come 2025, 2028 time frame. And it's going to be nasty. Now, when you have a line of credit, it exists for a period of time. Most organizations classify new credit between 2 to 4 years or less. So once you've cleared the 2 to 4 year mark on that line, it's no longer quote unquote new. Although respectively to something like, say, a mortgage, it's incredibly young. Now, how they're comparing these is quite simple. That new line of credit, realistically, is nothing more than just a line that you opened up. And its length, as it continues to grow, so does the history of payments. So if you've had this card for 12-month payments for 10 years, you got 120 payments building on a bulk for that card, which makes you much more resilient to hits because your average has to be driven down in percent of payments. That's how they calculate it. It's percentages of payments. And this is one of the first mistakes that organizations make on credit repair. Where you have to fix things is almost always statistically, and I would say over 95% of all cases of credit repair, the issue falls within payment history. Within payment history, well, I would say, to be more fair, is payment history and in utilization. That's what I find is both. And when they pay that off and they end up closing out cards and they end up fixing these issues, that's where the major score jumps increase. But the most ones are found within two areas. One is reducing card usage liabilities, and the second one is fixing card payments. Now, with that being said, mix of credit. Because length, the longer you've got it, the better it gets. Mix of credit. This is also something that I disagree with. And here's why. Mix of credit says you have this kind of loan, auto. You have this kind of loan, credit card. You have this kind of loan, personal. You have this kind of loan, mortgage. You got all these types of loans. Awesome. That's a line of credit. That's a static loan. That's a static loan, but it's real estate, a real E, and that's a static loan. Here's the big deal here. This is a secured loan. This is an unsecured loan. Allegedly. Realistically, they're going to pursue you and they're going to pursue your assets to reclaim that balance regardless. So it's not really unsecured. They're all secured, just so you know, because they will pursue you in court for their money. Now, you got your line of credit and you got a static line. What they say is, if you've got all of them or more than one of them, we give you more points. We reward you with having more lines of credit. But then we penalize you, again, remember, length of credit, for the exact same thing. Because remember, most auto loans are going to be between 1 and 5 years. Most auto loans, 1 and 5 years. So, what that means is they will always be new. Over 80% of the time. They're always going to be new. So they're going to ding you. They're going to ding you for 15% so that they can increase you for 10%. How crazy is that? So they're literally going to take 5 points. They're going to hurt your credit for having credit. They're going to hurt your credit for not having credit. This is why no one has a perfect credit score. Not even the company CEOs for credit bureaus. The system is designed mathematically to keep you from having a perfect score. Now, with that being said, here's the fun part. Here's the fun part. On mix of credit, you have a mortgage. You have a car loan. You have a personal loan. These are all static. They have a finite length, limit, and duration for balance and longevity of that loan. We'll say 15-year mortgage. We'll say a 5-year car note. We'll say a 3-year personal loan. At the end of year 3, 36 payments transitions to 0. That credit line doesn't exist anymore because that loan was successfully paid off. So any additional benefits you got from your payment history, that's now gone. 5 years comes by, 2 years later. That's 60 payments. Guess what? It goes down to 0. You just took another hit to your credit. Successful payoff. Car, oh boy. Personal loan, oh boy. Your mortgage. It's 180 payments. Guess what? Guess what? Yep. It's gone too. It's gone too. The day you pay off your mortgage, the average credit score drops 100 to 135 points. Boom! Just boom! It is the biggest shell shock to the average borrower in the history of mankind. You could pay all 3 of these off perfectly, completely perfectly, not a single issue ever. The second you pay them off, all good history is gone. It is gone. And I cannot stress that enough. The second you pay off your mortgage, that history benefit is gone. And it hits you like a train. And it is mind-blowing to people that they take such a huge hit. But that is exactly what happens in exactly that order. And that's because if you have 180 line payments, and that line is now closed out because it's satisfied, that line no longer exists. So that benefit no longer exists. Yes, it is on your credit history. Yes, you do have that trend of all these payments. Guess what? I take all of my loans through a server. This server will never just randomly call me and say, hey, Phil Morris of 123 Abigail Drive lets you know that he's never missed a payment on his house for the entire house he paid off of 180 payments. I never see this. Guess what I see? I see a score. That's all my system sees, and it's either above the threshold or below that threshold, and you're either being approved or denied instantly. I never even see it. I never even see it in my system. And that's because I never bothered to. Now, sure, you can request that I look at it manually. I don't have to. All I have to do is send you a letter to say why you were rejected, which is a generic statement based on your credit score, blah, blah, blah. That's just a generic statement. Now, the issue with this, where I take a lot of issue with this, is if your score is 180 payments and 60 payments and 36 payments, that is 6, 8, 11, 17, 276 of 276 that your score is no longer taking benefit from. What this tells me is that the system does not care about your previous history of payments, which is the whole point of a credit score, which is to tell me what your score history is based on your performance, historical performance. This is the whole reason why I pay credit bureaus in the first place. And this is what they do. they nullify it from the scoring engine, which is why I disagree with it yet again. But this is how current industry does it. Not the way I like to do it, or that I'm moving to do it on my own way, because I don't agree with the system. Again, because guess what? You've got your other credit cards, sure, and you've got 6 years. We'll say you paid all the stuff off in 6 years. You've only got those 3 lines left. You've got 12 by 6 by 3. So 36 by 3, you got 92. No, you got 108. So you have 108 payments, but you missed 6, remember? So you've got 102 up here. So you have a 95% payment history all over again, even though you successfully satisfied that mortgage. How crazy is that? How crazy is that? So you've got 36 by 3. Oh, sorry. No, we had to add that. So we had to double that. So it's 216 by, we missed 6. So 200, what is that? 210? Yeah, 210. What's 210? 210. So 3 more years has gone by. Let's go ahead and do that math. So it's 210, 216. You got a 97.2. 97.2%. 3 more years. Now remember, you've paid off a mortgage, you've paid off a car, and you've paid off a personal loan, and you've missed no payments. So had you considered those as well, in addition to the current ones you've got, you would have 216 plus 276, 492. So what is that? 46 over 492. You would have an assessment of 98.7% payments on time instead of the 97.2, which this would round up to 99% on-time payment history, which would drastically increase your score. But now, again, you see why they're doing this. Because they intentionally want to drive your score down, not up, based on what your historical performance is. Why would they penalize you for good things paid on time, and also penalize you for things not paid on time? If a bad thing is on your credit score, it stays in your credit score for a decade. If a good thing is on your credit score, the second you pay it off, it's gone instantly. But here's the catch-22. If you settle off a debt for less than the amount owed on a collections account, that still hurts your credit score. The line is closed. It still hurts your credit score, though. It does. And that's the crazy part. And it's ridiculous. But if you close out a line because you successfully paid it off, it doesn't hurt your credit score. And these are things that I don't agree with. I don't like these as a lender because it doesn't give me a true image of who you are. Because I would lend to someone with a 99% estimated payment schedule with the ability to pay off a mortgage in 3 years. That's unheard of. The financial strength of that individual to wipe out a loan, a car loan, and a mortgage in 3 years is incredible. They have extremely strong finances. Unfortunately, the scoring system will never get them to me. And that's part of the problem. That's why I openly recommend small lenders. Because small lenders will look at this stuff. I'm not big enough as a small lender to do anything other than automations. Once I get a little bit larger, I'm going to start doing this my way. And that's because I can look at it personally. And that's okay, because these are the guys that would fall through the cracks that I would come back and later approve. But that's the reason why. You have to see that in order to see it. But the issue is so many people apply for loans. There are 368 million Americans in the U.S. alone, and all of them want loans. And there's our problem. There's not that many lenders, and even with the lenders out there, there's not that many people in lending to handle that workload. And that's where part of the problem is. Now, the other one is the pursuit of credit. Now, pursuit of credit is quite simple. Did you or did you not come in and ask for credit, yes or no? Your score is going to go up or it's going to go down based directly on did you try to get new credit. It dings you at, I think, 2. After 2, it starts to hit you for about 7 to 14 points. So it's like 14 and then 12 and then 10 and then 6 or something, whatever. That's what the trend seems like. The more you have initially, the more it hits you for more points, but it has a declining trend. For the more inquiries that you have, the more it hits you for less. So after 2, it'll hit you for like 14. On the fourth pull, it hits you for like 12. And the fifth pull, it hits you for like 8 or whatever. But that's how it works. It's got a diminishing returns of damage. But the reality is, it's still damage. And this is why I don't agree with it again. What they tell you is it stays on your report for 2 years. The reality is, it only impacts your score for 3 to 6 months. Unfortunately, for lending, it impacts you for the full 2 years. And that's because you had an inquiry. The system sees the number of inquiries you've had. And that's why I think it should be illegal for people to just randomly hard pull your credit. I don't think they should have the authority to randomly hard pull your credit at any given time because it hurts you financially for an extended period of time. And I openly tell people, if you didn't authorize a hard pull, automatically protest it. Even if they have a piece of paper that says that you gave them permission to pull your credit. You did. One time. And they pulled it that one time. If they come up randomly 8 months later and they pull your credit again, 1, 2, 3, 4 more times, protest that and definitely take it to court if you need to. Because remember, it's 14, 12, 10, 8. That doesn't sound like a lot, but when you add these up, that's 6, 14, that's 44 points. That is a difference between a 640 and a 640 and a 684. This is a difference between being approved for a mortgage. This would get denied. This would get approved with stipulations. That's the distinctive difference. That's 44 points. A 600 and a 640, that's the difference between getting an SBA loan or not. With the sole exception of being like a VA loan, which is like a 580 or something insane. It's like super low, which I appreciate as a veteran. They really do go out of their way to help veterans, especially those that may have issues making payments because of unfortunate issues with combat. I mean, that is what it is. All right, I'm moving forward. So, this is the hows and the whys. We're gonna briefly touch up on this on how the actual process works. So, you apply for some line of credit. So, what you do is you send me your data to my system, some kind of online platform, maybe an in-person paper form, which is really rare these days. But you give me your data, and that data goes to a service. And then once it gets to that service, sorry, I had a call come in from a spam number, it looks like. So once that data comes into that service, the service receives it. It's normally some kind of system. Our system receives it. We process it on our server backend based on our criteria. We have an API call on our backend of our server that goes out to the credit bureaus, to the 3 credit bureaus. I'll just draw 3 boxes here. And what ends up happening is that API call responds back with your data from your service history, from all of your loans, all of your payment history, all of your collections accounts, any kind of public records or documents. That comes back to our system on our backend server service, and that service makes the credit decision, normally within a fraction of a second. That time frame is normally between 5 and 85 microseconds. Sorry, milliseconds. So 5 to 85 milliseconds, we've made a credit decision. That's how fast we make a credit decision. And that's based on a portfolio of decisions that we've made. So each lender has a series of portfolios. I have a series of portfolios, and each one has different base criteria for approval. Whether it's score-based, maybe it's payment history, maybe it's certain items here that can be or can't be accepted, certain types of items that can or can't be accepted. That's how our portfolios actually work. And it's very simple, very straightforward, very easy to understand. Either we like it and we accept the risk, or we don't like it and we don't accept the risk, and the interest rates vary wildly. I've seen interest rates for as low as 2.5% to as insane as a godly 7.95. Like, boom. Like, dude, don't get that for your mortgage. You won't make the first payment on that house. They are crazy high. But each lender has their own appetite. Whereas in me, I lend in the safe to moderate zones. Some people, they'll just give anybody a loan. And they're just like, I don't care if you default or not. You'll make 3 payments and then I'll come and collect whatever is left. And that's what they do. And they just bulk volume that, and they're predatory lenders. So that's how it works. It's a very straightforward process. You're either approved or denied. If you're approved or denied, Legally, we have to let you know if you're denied. We have to send you a notice that says this is why you were denied. It's a very generic templated statement. They're all the same. We copy and paste it from legal. Legal provides it probably because they've provided to the same 500 customers over the past 20 years. And it's the same statement. This is why you were denied based on your credit report from Equifax, TransUnion, Experian, blah, blah, blah. And if you want to know more, please send them to a P.O. box that they never respond to, which is not their headquarters address, which you can Google. And that's how it works. That's the approval denial phase. And then if it's approved, we track it active basis. We don't report on anything that's 29 days or less. Some lenders only report on bad items, which I don't agree with. I think if you are reporting on a payment, you should report on the payment, good or bad, based on the agreements that you have. Let's see what else. There are instances where lenders will remove things. It's normally under a good faith letter is what's normally sent, and then we'll receive those, and then we'll make a judgment call. I'll go ahead and give you the insider on that one. Most lenders will not, and that's not because they're malicious or vicious or evil. It's just because their systems literally won't let them. So what ends up happening in a lending institute is you have multiple tiers that you operate at, and everything is inside this tiered system. It's a reverse pyramid. The higher up you go, the more power you have. The peons at the bottom, or the employees, they have almost no influence whatsoever. They have almost no influence at all. People at the top have almost all the influence. The only thing they don't have influence over is their investors, which they try to make them happy, and it is or isn't what it is. So the area that you have to get to is at least the third tier. The issue is you interface with the second tier. On escalated events, on average, most of your things are received at the first tier. This has to go up 2 tiers to get to the VP level, who has the authority to do something. The problem is, most of them will never make it past the second tier. And that's just a simple reality. Now, there are cases, there are handfuls of companies who have streamlined that process. USAA, Ford, Chrysler, Verizon, companies like those, they do have the capacity to fix it. Whether they choose or don't choose to depends on the business relationship. So like say for instance you've got like an 850 credit score, a payment goes awry for some reason, you've never missed a payment ever, and you've been with Ford for like 30 years. There's a very good chance they're going to fix that problem. And that's because they don't want to lose that relationship, because contrary to popular belief, even big businesses appreciate lengthy relationships, and that's because they translate directly into money. But that's just simple business logic. Now, when it comes down to credit itself at the agency level, so we're talking at the agency level with the bureaus. Moving on to the next topic, the next point. These bureaus are all regulated by different state laws. So the law is applied directly correlative to where the consumer is located. Now, why would that matter? Why would anyone say, why does where I live matter? Well, quite simple. The state law. The state law directly dictates what they report on, how they report on it, and the ways in which they report on it directly. And certain states are far more friendly towards consumers than other states. The one I recommend the most, and pretty much the only reason why I recommend this state for anything, is New York. If you live in New York, negative items can only be maintained on your credit score for a maximum period of 5 years by law. 5 years by law. If you lend in New York, you can only report negative items for up to 5 years. Then you must cease reporting them. Now, getting to reporting. If you have an item that is negative and outstanding, there are a double-edged sword in play here, which is it is outstanding. And it's delayed exit. Now, the longer an item is outstanding, the closer that item gets to expiring. However, at the same time, the closer it gets to expiring, the longer it has been outstanding. And if you decide to do something about it, it will immediately refresh its expiration date. So if you wait 4 years and we'll say 11 months in New York to pay off some X defaulted item, it will immediately refresh for another 4 years and 11 months to expire. That has been a negative item on your credit score for almost 9 years. I do not agree with this either, because it is saying that this negative item has dictated what you can or cannot be in terms of creditworthiness for a decade. We have gone through multiple presidencies. You have gone through a decade of age development. You have gone through 3 phases of life, if you're a millennial, guaranteed, scientifically, physiologically, and psychologically developed 3 different times. There is no way you are the same person I would have lent to at 18 as you would be at 28. There is no way, mathematically or scientifically, to support that evidence. That is impossible. But that is what that system will tell me, is that you are uncreditworthy for 9 years because of a whopping $10 payment. I have seen something as stupid as $10 is holding people back from success in life. $10. This is also why I disagree with it. I think that the score impact should be correlated between the payment history and the amount of payment due. Because if it's $1, it should not cost you 150 points on your credit score, keeping you from hundreds of thousands of dollars in loans because of a petty balance. I think all petty balances should be immediately stripped away. Anything under $1,000 should be nullified after a period of time. That's just my decision. I think, honestly, all of them should be tiered nullified, and that's just because it shouldn't be on there and impacting you that severely, and it should just stop once it's defaulted, because that's on your point of default, that's the point of impact. That's the point I'm concerned from. The further I get away from that point is the further I got away from whatever in your life caused you to default on your payments, and you're further away from that now, you've improved. That's what my personal thought is. Unfortunately, that is not the thoughts of the system. Now, moving forward, how to use your credit. This is the biggest mistake used by everybody all the time. It is the biggest, most substantial misuse of credit in the history of mankind. Credit is a tool and a means. It is not an income. If you are spending money you don't have, you need to stop immediately. Stop what you're doing. Stop. Build a budget to get away from this. If you can't successfully build that budget living on your own, get married, get a roommate, or go home and live with your parents. One of these 3. Because you can easily get divorced. It's actually really cheap. You can easily get a roommate. That costs slightly more. And you can move back home with your parents. That costs the most because you have to file a break lease. Now, the reason why I say this, do these, because one simple issue. If you take, under any scenario, the fact that 25 to 35% of all people's money is spent on rent, and the other bit is 25% spent on bills. If you cut this even in half at 60%, you have done slashed your cost by 30%. Low end, it is 25%. This is the difference if you do one of those 3 things. Get married, get a roommate, or go home. You will reduce your costs by 25 to 30% at a minimum. And that will substantially increase your financial performance. And that costs you varying degrees. It costs like $200 to get married. It costs like $200 to get divorced. It costs, well, if you have all your paperwork in order, it costs like $200 to get divorced. If you get a roommate, if they're a good roommate, it doesn't cost you much anything other than a Craigslist ad. If you go home, it may cost you a break lease. But what it won't cost you is 10 years of misery and suffering if you default on a payment or a series of payments because you're financially overwhelmed. Now, it is a lever. Use it accordingly. Credit is quite simple. You can leverage credit to acquire income. You can buy businesses through the SBA. You can buy real estate through a VHA, an FHA, a USDA. A, an FHA, a USDA, a, FHA, a USDA, a, 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 USDA, a A Fannie, a Freddie, a VA, I can keep going. There's all kinds of private. It's just, there's a huge array of ways you can acquire a means to income with credit. But leverage it accordingly. Make sure you've done the math. Make sure you've done the assessed risks. Make sure you understand the industry. Very, very, very important. Credit is a great safety net. Credit is an amazing safety net. What I recommend to everyone, you have 3 months of savings for all of your bills at their maximum performance. What that means is, what is your electric bill at its maximum? Summertime, it's going to go up. We'll say it's $900 a month. You need $2,700. If your rent is $800 a month, it is $2,400. If your cell phone bill, with all those little random download charges you got, is $250, that is $750. If you've got a water bill, it's $100 a month, it's $300. You take all of these sums, your credit card, it's maxed out, $5,000, we'll say 10%, it's $500, you need $1,500. You take all these balances together, 27, 24, 750, 300, 1,500. You take all of it, you add it together. You got 7, 5, 8, 15, 19, 19, and 7, 26, 2, 4, 6, 7. You've got 7650 in reserves. You take an identical balance of 3 months for credit, which means your minimum available credit needs to be 7650. And then 7650. You have roughly $15,000 put aside. 3 months, and then 6 months. I recommend 6 months for an emergency savings reserve. 3 months is your standard reserve. 3 months is your credit reserve. 6 months is your emergency reserve. That's all of your savings and all of your available credit. Everything else is investments or other means of acquiring income. You've done something to go out of your way to acquire other means. Now, that's what I recommend. You don't have to necessarily follow that, but this is the best way to build that safety net. Now, in addition to that, my personal favorite use of credit is it is a great backup plan. All of my businesses, when I pursue investors, I leverage credit as a means to acquire a backup plan, an exit strategy, what I call the golden parachute. I leverage that as a means to ensure if something were to happen and we don't meet our metrics, we don't meet our sales quotas, we don't meet our performance over a period of time that's lengthy in duration, we leverage credit to finance everything together, and then we exit those investors to protect their money. That is something that's unique to my organization, unique to me. That is something that I developed and designed personally. It's my way of protecting my investors because they've given me an opportunity to protect my company, to provide for my company, build my company. I want to provide them that same level of coverage, same level of protection that I can, which is to ensure that the business is also protected, the personnel in the business are protected, and the investors are protected to continue and maintain that relationship. That's me. That doesn't necessarily mean that's you. Now, we're going to cover credit services. Now, credit service repair companies. I do and I do not like them. They are both good and bad. Now, with a credit service repair company, there are some goods and some bads. The goods are they can fix genuine errors, mistakes, or things that were intentionally put there just to hurt you, to extort you for money. Those things can be removed. Those are the things that you protest, things that you know aren't accurate. Not things that you know are accurate but you don't want them there anyways, but things that you know are not correct. Those are the things that you protest. And that's a great thing because it will, the next line, absolutely fix your credit for some issues. If it is erroneous in nature and you know it or believe it to be erroneous in nature, you can protest it. You can provide proof. Provide the proof. Do not go through the credit bureau's online automated no statement provided, type in 250 characters to tell us everything in your mom about this issue systems. Those are garbage. They are designed to waste your legally and lawfully entitled rights to protest issues. Absolutely do not do that. Do not do it. Do not do it. Absolutely, for the love of God, do not do it. Because once you do that, they will say you have already previously protested this item and there is nothing you can do. Leave that to a professional. If you feel there is an issue on your system, This is when you call a credit repair service because they know what to do. They have the systems in place, they have the processes in place, they have the legalities in place to be able to effectively protest these things. Now, do not go to some wheel and deal credit repair service that's just going to send complaints and file a templated, pre-templated excuse. You want a customized letter. Ask them, is it templated disputes or is it a customized dispute? Because you want a customized dispute because you have a customized case. If it is a templated excuse, it is general in nature and will be rejected with the same general in nature statement. Your general in nature statement will be responded to with a general in nature response. If you send a customized response and they do not have a customized response, you can dispute the fact that they did not properly access the case, review the case, and respond to the case in court. And that is the next step, which is legal. If they refuse to fix it at the credit bureaus, sue them. I guarantee you the second you file that lawsuit, it costs $45. That is cheaper than most credit repair services. You file that legal dispute in the court of law and a civil case, I guarantee you 9 times out of 10 that problem magically gets fixed because the last thing they want to do is pay for the damages to your credit, which is exactly what I tell people all the time. If someone has illegally or invalidly sent something to credit, you've talked to them, they've refused to fix it, you've sent it in a dispute, the credit bureaus refuse to fix it, take them to court. Sue both the credit bureau and sue the company. I guarantee you one or the other will fix the problem because it's not worth the $5,000 in legal fees to fix the $45 problem with a $7 fee. That is what it costs to send in that change. It is $7. Some of them it's free because of the service tier that they have through the credit services that they're using through a distribution house. Some of it's $7, some of it's free. It is far cheaper to pay $7 than $5,000 because that is the legal retainer they're going to pay for the attorney. I guarantee you that's what's going to happen. Now, some of the bad stuff. A lot of these times when I go and I pull a credit report from somebody and I see a lot of disputes, like a series line of disputes, what this tells me is that this person went through and disputed everything. What this immediately looks like to me is that you are very aggressive. You're very aggressive towards your credit, which means you will be aggressive towards me. Because aggressive is aggressive. That's just a basic assessment. If you are aggressive towards your credit, you will be aggressive towards me. And if you will be aggressive towards me, I will say no to limit my liabilities. If you come off as hostile, if you come off as aggressive, if you come off as belligerent, that is what will happen. You will be automatically rejected. And that's because we don't want to deal with the headache. Like I said, we don't want to pay the $5,000 retainer fee. Me, that's why I built a law firm. I have a law firm. I don't pay any retainer fees. I eliminated that liability. But I still don't want to deal with the headache. I still have to pay those attorneys. They still have to go out and deal with the case. I still have to pay something. And I don't want to pay anything. And if I pay something, there's a great chance it'll consume the interest that I made, and it'll cost me money to deal with that case. I don't want to do that. So I'll just say no. The other issue with these guys is they're unregulated. There's no one regulating these companies. You can, right now, if you're watching this video, you know enough about credit to go out, download the templates off of Google, and start your own credit repair service. Here's the problem. That doesn't mean you're qualified. That doesn't mean you understand credit. Me, I'm a lender. I understand credit. I could validly deal with that. I have a law firm backing me. I can deal with these issues. I can go through all these problems. I can finish up my law firm, get it established internationally, get practice rights in D.C. Through D.C., I can practice in every state. And I can go forward with everything and deal with all these issues. You cannot. You don't have attorneys, a wall of attorneys to be like, hey man, we've got another business case coming in, go deal with that. You don't have that. It's just you. And that's why I have a problem with a lot of these services is a lot of them don't have that history. If they don't have that history, I am wary of them. You should be too. Doesn't mean that they can't help you, and doesn't mean that they're not great. It's just I would ask for a substantial amount of evidence before giving them my money. That's all I'm saying on that. Now, they have no guarantee of success. There is nothing contractually that they will give you that says we guarantee we'll fix your credit. If they did, that's outstanding. Statistically, they do not. They don't guarantee results. If they can't guarantee results and they're expensive, I wouldn't recommend using them. It's a hit or miss. But overall, there's no guarantee of results. None of them are regulated. and you can come off as the wrong way or have that wrong appeal on your lending reports, on your credit reports, and that's going to directly impact your ability to get loans in the future. I say that from firsthand experience because I openly reject people that have a large amount of disputes on their credit report because they're aggressive, and if they're aggressive, that's a concern for me because, one, it tells me they're using a credit repair service, which means what was their score before, and why was their score that way before. And the other issue is they're very, very aggressive with their credit, obviously, because they wouldn't have gone through the trouble of paying a service. And if they're aggressive with that service, they're going to be aggressive with me. That's just the way it's going to be. Now, the do's and don'ts in credit. If you're going to have credit, you're going to use credit, you need to make scheduled payments. That's just bar none. 35% of your entire basis is based on your credit payment history. The other 30% is based on outstanding debts. If you're not making scheduled payments, 65% of your score is toast, and you will never get loans again, period. Set up auto pay. It is the easiest thing. Every major financial institute on the planet accepts auto pay systems. They have auto pay systems. Banks, go ask your bank. I guarantee you they have a payment history of some kind. Not payment history, payment service of some kind. They will make payments on your behalf. They will mail those checks. They will arrive on time. You just need to bring in the bill and bring in the payment date. They'll make sure the payment's there before that payment date or on that payment date to ensure it's paid on time. They're great services. A lot of banks and credit unions offer them for free. I absolutely recommend it. I also absolutely recommend you take that 3 months that I told you to save up and put that in an account specifically for that auto pay service to ensure your bills are always paid on time, and all you're doing is putting more money in that account to ensure that account is constantly full because that safety net's already in place. Everything's lined up to go. You just have to use it. Now, that's hitting the services, the savings. We've already got that covered. You absolutely should. You absolutely should contest any kind of invalid information. But you definitely, again, just to reiterate on it, need to work with a professional agency. I absolutely recommend that. Please do that because they will save you all the heartaches and learn all those hard lessons learned from other people the easy way, myself included. In the past, I've had issues with credit. I wrote a book on having issues with credit. It's actually going to be published here pretty soon. I'm super excited about that. But I'm not here to do a buy my book drop. No, it's just I'm writing a book on it. It was an awesome experience. I had a great experience with my credit repair services, but mileage may vary. Now, the other thing you need to do is call your creditors. Please, please call us. If you're having an issue, we are human. We swear. I am flesh and blood. I promise. I promise. If you have issues, call us, man. Call us. Call us, call us, call us. Because you would be amazed at how well we will respond if you just call us and be like, hey, look, I'm a federal employee. I've been furloughed during the latest government shutdown. I just need some help. You know what? You, Mr. Johnson, you've been a customer of ours for 5 years. You've never had a single problem. We're going to go ahead and freeze your payments. We're going to freeze your payments until the furlough's over. You would be amazed at how many banks will do that for you because they get it. They know for a fact you're getting paid. They know for a fact you have money coming in. They know for a fact it's coming. They just know that it's not coming today. And that's fine. Some banks, they'll just freeze it. We freeze it. If you have any issues with your payments ever, call us. We will freeze it for you, especially if you're in law enforcement or military or you're a teacher, organizations that we like to protect. We will help you. You have to call us, though. We get it. You're on strike because you're not getting paid what you deserve. We get that. I get that. That's a personal rule written into our systems. If you're a teacher and you need help or assistance, we will help you with that. If you have creditor issues, call them. Please call them. Call them. Your car companies will work with you. Your mortgage companies will definitely work with you because I promise, cost of bankruptcy, way more expensive than just saying, you know what, we're going to furlough 3 of your month's payments just to help you out. I promise, it's way easier to do that than to go through bankruptcy. That is the hardest issue to deal with. It is a nightmare. It costs tens of thousands of dollars. It's cheaper to just be like, you know what, we're going to move these payments at the end, and we're going to make more money doing it. It's way easier to do that. The thing you do not do, the thing you absolutely do not do, is ignore your creditor. If I call you, if they call you, please pick up the phone. We're not there to harass you. If we don't know because you didn't tell us, we can't update your record to say, hey, teacher strike. Hey, government furlough. Hey, this guy's got a thing going on because he got injured, their workman's comp, and he's got a claim going in. We don't know these things if you don't tell us. If you don't tell us, we just assume you're dodging us and you're refusing to cooperate. That is the de facto. If you do not answer, you do not respond, we can only assume you've skipped town on us, and we have to do everything in our power at that point to move things along very quickly to get our money back because we think you've ghosted us. We think you've ghosted us. And that's the issue. If you don't pick up the phone, we don't know that that's not the case. And again, we get it. If things have happened, we'll work with you. Almost always. Almost all creditors will work with you with few exceptions. Ally is one. I've seen negative things from Bank of America. I've had personal experiences with issues with Ally, so I get it. I get it. Some of them won't work with you, but a lot of us will. Now, what you do not do is attempt to harass your creditors. Do not harass your creditors for credit reporting or for otherwise. Don't get belligerent with us. Don't get aggressive with us. Do not start swearing at my employees because I take that very, very seriously. Do not start threatening people. That is a guaranteed issue. You're going to get law enforcement calling you, and almost all the calls are recorded, almost guaranteed always, and that's a great way to go to jail. Don't do that. Another thing you don't do is ignore the notices or judgments. If you've ignored us for long enough, you're going to start getting notices in the mail. You're going to start getting judgment notices because we took it to court and you didn't show up, or we've sent you a sheriff's warrant or a sheriff's summons, and we're bringing you to court because we're suing you for whatever, and we're coming to get our stuff, or we're coming to get our money, or we're coming to recoup our losses because you didn't cooperate. That's not something you want to ignore. Because if you fail to show, you fail to appear, the judgment is default. It is a default judgment in our favor, always. If you don't tell us what's going on, we can't work with you. Because I guarantee you, if you show up to court and we have attorneys in place that are there, they're representing us. And if something horrible's come up, like you're a service-disabled vet and something's happened, and it's like you had to buy medication and buy food or pay a bill, I guarantee you that attorney's going to call us and be like, hey, look, we got a situation, and here's what's going on. I guarantee you, I get a call like that, we're going to have a conversation, and we're going to work something out. But if you've dodged us, there's a great chance that we're not going to deal with that. And that's because if you've dodged us and dodged us and dodged us, and the issue wasn't that big of a deal, and it was just a conversation away, we're not going to help you. And that's because you didn't do what you should have. Now, if you're like a service-disabled vet, and you were in like a coma or something crazy, and like we get that call, and we're like, hey man, this guy just came out of a coma like yesterday. The first thing I'm going to be like, so you know what? We're going to ask for a temporary stay in the case while we look into working out this issue. Go ahead and let the judge know. And that's the first thing the attorney's going to do is like, hey, sir, we're looking for a temporary stay or extension or whatever. I forget what the term is. It's attorney speak. It's not my wheelhouse. But they'll ask for a stay. They'll ask for a delay, whatever jargon they use to do that. And we'll get a delay on the case for like 3 months, 6 months while we figure out what's going on. Because if you just came out of a coma, that's crazy. That's crazy. Like I said, we're human. We will work with you, but you have to let us know. And the last thing, do not ignore the collections calls. My collections calls cost me 0.004 cents to send. It costs you nothing to answer it. If you answer this call, we can fix the problem now. And it costs me 0.004 cents plus, we'll say, on a call center cost, total call center cost, I think it's like, what, $12 times 1.4 is like, we'll say $16. It cost me a grand total of $16 to fix this problem. If it gets to court, it costs me $5,000, which, by the way, according to our contracts, you will pay that. You will pay that plus the court costs, plus the fee, which is like $545 plus $5,000 plus blah, blah, blah. Legal fees and court costs and summon fees and blah, blah, blah. You'll pay all of that. So again, do not ignore that call. This call costs you next to nothing to answer. It costs me next to nothing to answer, assuming it takes a full hour, which it won't. It won't. It may cost me $5 to fix a problem before it becomes a problem. It will cost me substantially more to fix the problem after it's become a problem. So please, answer the call. But I definitely thank you guys for your time. I know this has been a long video. It's been a great video. I love this topic. Credit is definitely one of my favorites. I definitely enjoy it. I wouldn't have written books on it if I didn't. I'm super excited about the books coming out. I'm even more excited to know that there are other people out there that are now actually informed on how credit really works, how credit really functions from a lender's perspective and from an individual's perspective, both on good and bad credit. Credit is absolutely an amazing tool to use if used properly. It is the most world-shattering, life-ruining issue if you don't. And that's why, again, I'm very much so against the current system. But at the same time, it's the only system that's actively in place, functioning, real-time, right now. And so that's the lesser of two evils that we've got. And so It's unfortunate, but that is the way it is. Please let me know what your thoughts are. Please comment below. If you like the video, please subscribe. We're coming out with a lot more content every day. We'll be cranking a lot of content here in the next couple of days, couple of weeks, and I definitely love to share my knowledge with the world. So please let me know. Again, like and subscribe. Click the bell if you want to get the content up in real time. Thanks so much, guys, and I definitely look forward to your feedback.